Welcome back to the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth and successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falash, and the Group Practice Accelerator podcast is on the air. Well, hey everyone, thanks for joining me today because we're going to be talking about your growth strategy, your where do I want to be and why, and more specifically, your acquisition or de novo strategy. Now, there are plenty of group practice owners we work with who have their growth plan all laid out, and often that involves adding one or maybe two or more locations a year. Great, we love that. But sometimes we talk to owners who only do acquisitions or only do de novos and never really give much consideration to the alternate and particularly to a de novo strategy. And while there are some really different moving parts for both, when we're planning and executing specifically on a de novo strategy, there are some really solid reasons that we want to take a closer look, especially if you haven't been open to it before. So regardless of whether you buy or build, at the end of the day, I think we can all agree the purpose is not only to expand access to care, expand our business, but we want to build wealth. And we all do that for our own reasons, right? And we understand that your growth plan can also include a mix of both of those things. So we want to take some time today and shed some light, not only on buy versus build, but a few overlooked considerations around de novos that might change the way you think about them. And here with me today to help us better understand why a de novo strategy or acquisition strategy could boost your growth plan and help you build more wealth is Polaris's own founder and CEO, Diwakar Sinha. Diwakar, welcome back to the show.
Thanks for having me, Jamie.
Good to see you. So I know we have a lot to cover here today in a short amount of time, and we're stating the obvious because there are two ways to expand beyond our four walls: acquisition or de novo, that buy versus build that we talk about. So I want to go into some potential advantages, disadvantages of both. For example, acquisition. We know we've got a built-in patient base. We've got a built-in staff. De novo, we've got to start from scratch, new everything. But there's a lot more to it, as we know. So I want owners to think about their acquisition strategy and that why. So for them to consider what that de novo strategy could look like for them or do for them financially. So let's back it up a little bit and talk about when to buy versus when to build.
Great question. So just to echo what you said, I think naturally, when you buy a practice, there's a assumption that there's a patient flow coming with it. The assumption is there's cash flow coming with it. And in most cases, those are true, right? Because there's successful transactions that are happening out there. And, one of the things people need to be thinking about is when we're buying a practice, and we've said that in our previous podcast, is like, what is your ability to grow that practice from where it is doing today? And that's meaningfully important because you're trying to understand where your return on capital or things like that might be, post-transaction. And Jamie, you talked about building wealth. And then there's also the de novo strategy. So when do you do de novos? Historically, when people think about de novos, is they might have looked at an acquisition strategy and they can't find a good practice to start up to buy, so they end up starting up in a geography. Without a clear path beyond that, it's more of a reactive process. And what I want our audience members to do is kind of think about it. Both are really good strategies, and I have all the data to kind of think about it. So the key thing to think about when I'll kind of do some math here for our audience members, one reason to think about a de novo versus an acquisition is when you're buying a practice, what is the purchase price? What is the cash flow? And how much are you leveraging? And I'll kind of walk you through a conversation I had with a principal founder of a group.
Okay.
So they're looking at buying a practice, grossing a value of $2 million in valuation. And the EBITDA of this business was roughly around $300,000 of the business. Also, it's running about a 15% margin, within the business. Pretty healthy, I think, for a general practice. That said, they're buying the practice for, if you think about it, roughly 6.5x. One would say 100% revenue in different markets. That's reasonable, but they're buying for 6.5x in that aspect. Now, if they were to grow the business and continue to go down that path, and let's say their business is worth at X, the day after they close, it's worth $2.7 million. And if they can improve the value, the revenue or EBITDA to $400,000, it's worth at best $3.6 million.
Right.
Okay. Um, and depending on, let's say the deal is transacting at 9x or 8x, if the deal's at 9x, they're at a 70/30 cash at close, they're only getting 2.5 million of cash at close.
Got it.
After paying taxes on it, they're only netting 2 million or less.
Yeah.
Yeah. So I think, yes, you have this rollover equity component. Yes, you have the ability to kind of continue forward the journey. But your
Sure.
cash at close is not meaningful for the debt risk you took on. You have to kind of think through when you're trying to do acquisition, what is are we acquiring EBITDA to acquire EBITDA? Are we acquiring EBITDA to provide more access to care in a market? And are we acquiring that practice because we can provide meaningful opportunity and deleverage ourselves in that practice? So, that's when people need to kind of think about, hey, what is buy versus build? And then, once those factors come in and say, okay, well, maybe that leverage ratio is too high on an acquisition. Now we need to start looking and say, what are good demographics of markets that I can within that area I can go into and do a de novo. Now there's different things that people need to consider in doing a de novo, but they need to also think about, okay, if I put in $750,000 to $1 million in a de novo, what can my return on capital be there if I can get that business to a $400,000 to $500,000 EBITDA over 2 to 3 years?
Yeah, and you and I were talking through this scenario the other day, and I want you to walk me through, if you could, that financial scenario, the potential behind that de novo that you've chosen in the right demographic. You've got, all those other pieces in place that I want to ask you about a little bit later, so we'll get to that. But walk through that math for our listeners about the potential there and that difference between an acquisition and a de novo. And obviously, if you're choosing the right acquisition, this is a different scenario. But walk through that opportunity if you would.
Yeah, sure. Jamie, we're going to have a seminar about this in Q1 that's a little more focused and granular, with an industry partner that people can kind of, look into and say, okay, what does a de novo strategy look like? And they'll get the playbook, step-by-step playbook on how to think about this a little more granular. The return on capital on de novo. So I did the return on capital or potential positives and challenges in doing an acquisition is if you're investing $750,000 to $1 million into a de novo, yes, it doesn't have any cash flow going into it, but there's so many positive variables of designing your own office, building the office you want. And if you can get that practice to a $400,000 to $500,000 in EBITDA over 2 years, 3 years, 5 years. Okay. Now you have a business that can potentially transact for 6x, 7x, 8x, 9x, depending on the size of your business. And your return on capital now becomes exponential on that de novo versus that acquisition. Again, you have to have the fortitude to build a de novo, but the opportunity is meaningful to kind of think about it on a de novo strategy.
Yeah, there's a fear factor with that de novo strategy for sure. A lot of unknowns there. And obviously, like you said, our conference that we're putting together for Q1, we're going to help clients go through that strategy. But let's talk about a couple of things that you need to be thinking about with a de novo, meaning laboratory size, other facilities. Walk us through some of those things and give us a little sneak peek at that.
Sure. So the number one thing I always recommend to group practice owners is if you're adding locations through acquisitions or de novos, they need to be minimum 6 chairs. And if they're below 6 chairs when you're doing an acquisition, well, we need to think about expansion opportunities and be creative around that. But minimum 6 chairs to 8 chairs is really where you want to be when you're doing a de novo. You're going to spend $750,000, $1 million. You really want to get to a position where you can build a practice that's grossing $2 to $2.5 million. With being over reasonably utilized in the practice. So that's one. So the question ends up being, does the demographics support it? And what I always try to tell clients to do is, in a 6 or 8 chair practice, you want to get to about 2,500 minimum, really closer to 3,500 patients per dentist, because now you're in a market that has demand for your provider. And even if the population is not growing in that market, let's say it's only 1% per year, or it's flat, stagnant. When you have competitors coming into that space, you're addressing the competition early on, knowing that even if I go from 3,500 patients per dentist in a ratio down to 2,500 patients per dentist, because competition is moving in on a forward-looking basis, I'm still protected. There's still demand for my providers, my business, my value out there. The next thing to think about is distance from your current facilities. Is it going to be 10 miles, 15 miles, 20 miles? we need to be strategic about where we're setting up these practices and why we're setting up these practices. So the answer could be where my patient's coming from, my outlier patient's coming from. I use them as a baseline to build a de novo. And then also looking at demographics that say, you know what, if I set up a practice in that market, I can get a good provider there. We can provide better access to that community. And not only are we serving the purpose of providing access to care, but that's going to give us a meaningful outcome in a return on equity position.
Yeah, plenty of research to be done ahead of time, regardless. Also, I want to talk a little bit about the cost of capital. So those considerations obviously come into play with either scenario. Walk us through that a little bit, if you would. I know you and I started talking about this before, but talk about the capital cost considerations with acquisition versus de novo.
Yeah, so the acquisitions, depending on the market, right, they're going to be anywhere from 65, 70% of revenue. This is a doctor-to-doctor trade. In some markets, it could be at 100% to 125% of revenue, depending on the market. So I think that's how private practices or solo practices typically transact, as percentage of revenue. So what people should be thinking about is if the margin of that business is at 15%, and the business transacting at 100% or 125%, we need to start looking at that business as a multiple of EBITDA, because our ability to get our return on capital, especially if, because group practice is going to transact at a multiple of EBITDA, not a percentage of revenue. So as far as acquisitions goes, if you're buying something around 6.5x, the example I used earlier, even if you were to grow it, your return on capital might be 20 to 30% at best. That's a lot of it is going to be on the equity roll, not even going to be cash at closing. Versus if you're doing a de novo, again, using the same examples of $750 to $1 million. And again, $750 to $1 million is about a 6 to 8 chair practice being set up, not equipped. You might only equip 3 to 4 operatories to get into it. But if you can slowly outfit all 8 operatories out of it, you can build that business to $2.5 million in revenue or greater, get to that $500,000 in EBITDA. Again, that's about 20% EBITDA in that business. Then your return on capital becomes a 4 to 5x, depending on when you transact. So it's a meaningful outcome if you understand the de novo strategy really well. Not to drive everybody to do de novos, but there's a time and place for it. And de novos can have meaningful outcome if you still have a reasonable journey ahead of you.
Absolutely. So I want to shift gears a little bit because, we talk a lot about optimization on this podcast, and we're looking at the underperforming practice here. So one that is not fully optimized, and, those come across the market as often as any other, but talk about when is it reasonable to consider an underperforming practice?
Great question. So I think I alluded to that a little bit on the lease situation. And I said, if you go into a 4-chair practice, and let's say it's utilized and it's doing $750 in revenue, and the lease is expiring in 3 years or 4 years, I'm a big fan of those deals if the demographics make sense and leverage ratio makes sense. Again, all the other factors make sense, because then our client can go into that practice, get that practice from 750,000 to $1 million, $1.2 million in revenue. We have a 3 to 4 year run rate in the lease. We can work with the realtor company to work on concurrently finding a space at the end of year 2 if we need to expand and relocate that practice. And we can model out everything, the additional debt to relocate, the opportunity. So I think that's one example of an underperforming practice, or maybe the operatory size we would not want, but we have the ability to get in there, upgrade digital radiography, update some upholstery, some basic equipment in the first 90, 120 days, just to give it a fresh look, have a run rate in the practice, and then relocate in 3-4 years. The other example is when something's truly underperforming and it has a utilization. So meaning it's a 6 or 8 chair practice and it's grossing sub $1 million in revenue. That to me could be meaningful. Now you have to be cautious and understand, well, why is that practice only doing $750 to $1 million? So you need to, again, understand demographics within the market, look at the continuity of care plan from the seller staying on board or not staying on board, your ability to replace that doctor with an associate, and your ability to maybe you're contributing in that practice. But if you can take that practice that's sub million, that has a run rate to $1.8 million to $2 million based on underutilization, to me now we're kind of slicing the cake between a de novo and an acquisition, because we're getting at a reasonable price point. Typically, those are going to be $500,000 to $800,000 in purchase price. Maybe invest $100,000 to $200,000 in capex, and you're back up to existing cash flow and getting into that again. Not you still have to understand the risk of team members continuity of patient flow. There's a lot of still underlying risks that we need to kind of digest through, but overall, it can be a good hybrid model.
Yeah, that makes sense. And there are certainly a lot of operational efficiencies and things that you can overcome before you end up expanding. So that makes perfect sense. Now, let's talk timing a little bit. So when should you be thinking about buying, and what other considerations should be on your mind before you buy?
Yeah. So again, let's say your model is acquisitions, right? So I think, we talked about this before as four-wall utilization, right? So I think when you're looking to buy, you can have a bifurcated strategy where you're saying, okay, I'm going to continue to aggregate by acquiring and being strategic markets because the patient demand is there for me. But we also need to look within our four walls and say, am I fully utilized? It's going to be important for bank leverage, bank conversation, getting credit in the market, because a bank's going to say, wait a second, you have an 8-year practice that's doing $1.5 million while you're going to buy another practice. At some point, they're going to start to put the credit box around you. So I think we need to be conscious of where our inner efficiencies are, look at the doctor production, look at the total output of patient demand in existing locations, and then or concurrent be looking at acquisition opportunities in the market that fit the box, fit our patient profile, that give us the situation to say, especially if a seller is looking to transition over time, that kind of gives us a really good checkbox to a yes, assuming the seller fits our cultural mold. So I think there's a lot of things to look at and say, okay, I'm in a good spot here. I'm growing in my existing four walls. And the next one I'm looking at, seller's looking to stay on board with me. He or she's not exiting for the next 3 to 5 years. I want to give them a good opportunity. And I think we together in that new market, new geography, we can grow together better.
Well, it's certainly a lot to consider there with either strategy. And we have plenty of clients that want to go down one path and maybe change their minds and go down another. So always worth taking a look at whether they're underperforming or you're looking to buy or build. It's totally up to your strategy, and each one deserves a fair chance, right?
Yeah, I think wealth could be created both ways. And obviously it kind of made some, positive affirmations towards the de novo strategy. I think that's really an unknown for a lot of people that comes from a position of uncertainty. And, I think if you can create a really good business plan around a de novo strategy, the de novo strategy in some ways could be much more meaningful to an outcome than an acquisition.
Yeah, I think once people can get past that initial unknown, as you said, that little bit of fear factor of really starting from scratch, I think you can prove that out. And like you said, make that a really meaningful path to building more wealth and, again, more access to care, which, is a subsequent benefit. Well, Diwakar, thanks so much for joining us today. Certainly lots to consider for either side of the fence here or a combination of that. So thanks for walking our audience through that conversation.
Yeah, thank you. And like I said, we're going to have a seminar in Q1 about specifically design around this. So I hope our audience members stay tuned for that information in the near future.
Sure. We'll have more to come on that very soon, and we'll certainly make some announcements and put some things out on LinkedIn as well. Well, we covered quite a bit here today, but as you might guess, there's a lot more to be thinking about regardless of your strategy, and we're here to support you. So go ahead and reach out to us and we'll be happy to set up a call. And if you'd like to learn about any of our Polaris expert advisory services, or maybe there's a topic that we haven't covered that you'd like to hear about, just go ahead and send us an email to info@polarishealthcarepartners.com, or you can check us out on the website by visiting polarishealthcarepartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, please share it with a colleague and be sure to leave us a rating on your favorite podcast platform. We'll see you on the next episode of the Group Practice Accelerator podcast.